I think we are live now. Welcome everyone to this DEA panel, this DEA event about the future of payments in the Euro area, where we discuss possible digital euro. I am very thrilled to have all of you guys here on this panel. And before I introduce you and we will dive into the discussion, I will ask my colleague Konrad to introduce the DEA to the audience.
Great. Thank you so much, Valentin. It's my pleasure to welcome everyone here today to the Digital Euro Association event entitled The Future of Payments in the Euro Area, which is set to be quite a great panel with very knowledgeable experts in this space. Before we get started, of course, with today's events, as Valentin alluded to, I'd just like to give a brief overview of the Digital Euro Association and make a short and very exciting announcement. So perhaps for those who don't know yet, the Digital Euro Association is the largest think tank in Europe with a particular focus on the digital euro. So what we focus on is contributing towards the political and public narrative through research and education, and by providing a platform and community for policymakers, technologists, academics, and others to discuss matters related to the digital euro and its development. So we do that via three pillars, namely education, community, and collaboration. And today's event is a good demonstration thereof, where we are bringing together knowledgeable parties to discuss important matters related to the digital euro. If you'd like to join and be part of such a discussion and perhaps benefit, of course, from knowledge from experts such as our panelists today and others, you have a couple of options, two of which, of course, is joining as an individual or as an institution. You can join as a fellow, as an individual, and this is, of course, free of charge, and you don't need prior knowledge of digital currencies or CBDCs to join. You could also join as an expert, and this is also free. However, you would need to provide 2 publications that we would have to review before we accept you as an expert. For institutions that would like to join us and support us in terms of developing discussions and contributing towards a narrative around the digital euro, we have active and supporting memberships. And we will actually touch on that a little bit later, but full details will be announced. If you'd like to reach out to us with respect to institutional memberships, feel free to contact us via any links posted in the chat today. A big thank you to those who have helped to make this event possible. Our supporting members being C Labs, Bundesdruckerei, Hamburg Commercial Bank, as well as Frankfurt School Blockchain Center. Thank you to these institutions that have really gone and partnered with us to make such important events possible. And now I'd like to move on to our exciting announcement. We have a new gold supporting member, and that is Ripple. We are, of course, delighted to announce that we have partnered with Ripple as a gold supporting member to jointly work on topics surrounding central bank digital currencies. Ripple, of course, is one of the leading providers of enterprise blockchain and crypto solutions for cross-border payments, and has recently developed a blockchain-based infrastructure to support CBDCs, and is engaged with Bhutan's central bank, amongst others, of course, to help execute their CBDC pilot. Ripple is also a member of the Digital Pound Foundation and continues to extend its efforts around CBDCs worldwide. Our partnership as the DEA, or Digital Euro Association, with Ripple includes, amongst others, joint educational efforts around digital currencies and other knowledge exchange. So welcome aboard, Ripple. Glad to have you on board. So if anyone would like to contact us in terms of also joining our community and helping us continue to make the discussions around the digital euro and its progress a reality, feel free to reach out to us via Twitter or LinkedIn, and also via the contact details that will be posted later on in the chat. Without further ado, I would like to move on to the business of the day and perhaps hand back to my esteemed colleague, Mr. Valentin Seehausen, that will take us through the remainder of today's event. Please also note that we'll have a Slido interaction where participants, or rather the audience, will be able to submit questions for our panelists to perhaps, time permitting, answer. So thank you very much, and over to you, Valentin.
Thank you, Konrad, for this great introduction of the DEA. The Slido code will be visible for, I think, 1 or 2 minutes. Maybe it's also possible to post the Slido URL into the YouTube chat for people to ask questions, because we will have a very long question round at the end, because this topic is very important, and we know from our working groups and our community events that you guys listening to us and watching us are very much interested in this topic. So yeah, my name is Valentin Seehausen. I'm a board member at the Digital Euro Association. I also work at the Frankfurt School Blockchain Center. I'm an economist and a blockchain developer, very much interested in this field. And today I am the one with imposter syndrome, because I'm sharing this panel with some of the most distinguished experts in this field. And we have Dr. Martin Diehl here. He's the head of section payment system analysis at the Deutsche Bundesbank, which is basically the German central bank. Welcome, Martin. And we have Anthony Welfare, the new role, European CBDC lead in global partnerships at Ripple, our exclusive sponsored partner. Very great to have you here. Welcome, Anthony.
Thank you.
We have Ezekiel Kopik, Ezekiel, right? The global head of public sector research and development of C-Labs, and C-Labs is another partner of the DEA, and I think actually the first one. So I'm very glad to have you here, Ezek. And last but not least, we have Professor Dr. Peter Bofinger, which is currently the chair of monetary policy and international economics professor at University of Würzburg, a beautiful city in Bavaria, and which was also a member of the German Council of Economic Experts. In German, it's called Wirtschaftsweise. So yeah, basically an economist idol of myself. Welcome, Peter.
No.
The digital euro, CBDC in the European payment area is a topic that drives us all, and especially the DEA community. And you all have you've written a lot, and you do a lot about this topic. Obviously, 2 of you are working at a technology provider that could provide the technological infrastructure to this. So I would ask you to introduce yourself and your current stand to the digital euro, or what you think is important around this topic. And I would like to start with this round. Maybe Martin. Yeah, thank you very much.
Okay, thank you very much. I guess you all can hear me. So I'm a central banker, having been working with or about crypto token, DLT, blockchain, and digital money alike for, I don't know, 5, 6, 7 years or so. And it has increasingly narrowed down to the topic of digital money. What should we do to support the use of the DLT in the economy? So I'm an analyst doing analysis in payment and settlement system, and that is the core of DLT, being a transaction technology. That's why it is important for us as central banks provide or take care of the payment system safety and efficiency are most important aspects here. And my main topic at the moment, research topic, is how to use digital money in a wholesale format for industry, for financial market, not so much related to retail issues of the digital euro, but how could we support the economy to make use of the DLT with either tokenized money, a wholesale CBDC, or any form of a trigger solution.
Thank you very much, Martin. Anthony, do you want to go next?
Yeah, thank you. So welcome everyone. Great to be here, and great to be representing Ripple now as we're one of the key partners now of Digital Euro, and it's very exciting times. My background, I've been in blockchain, enterprise blockchain for about 5-6 years now. I started with Oracle and working on really the early stages of enterprise blockchain solutions there. Moved to DXC Technology, where I led the global blockchain practice. So spoken to, it feels like hundreds of enterprise companies and banks and financial institutions. And really the last sort of 2 or 3 years or so, it's been very much focused around the payment side, obviously. Digital currencies, from cryptocurrencies through to digital currencies, CBDCs, has been critically important. And for me, tokenization as a sort of overview of all of these is just taken off everywhere. I'm sure we all know what NFTs are now. I actually wrote my book on commercializing blockchain back in 2019. And when we put non-fungible tokens, people thought we were talking about mushrooms or something. So now, amazingly, everybody knows what an NFT is, which is actually for the industry amazing, I have to say, for adoption of blockchain technology. It's fantastic. But it all comes down to payments. Let's be realistic. Everything that we do in life, there's some sort of payment, be it your salary, be it your taxes, or be it just paying a friend or paying for your drinks, etc. So for me, working through this new world of possibility of using blockchain DLT technology for payments and having what I would say is the top of the pyramid of a CBDC is it's the ultimate token in a way, in my phrasing, is really interesting, but it's so complex. And obviously within Europe, we have X number of countries, all of which are sovereign countries. In the Eurozone itself, there's X number of countries. So for me, the digital euro is the most complex and challenging. I think it's a lot easier in other countries. And that's why we're really keen to be, part of this. You need a lot of research, understanding, testing, and working this through, because it's not easy, but in my view, it has to be done. And, the sooner we get to more real tests, the sooner we get to more reality, the quicker it moves. The technology's there, give or take. It's just the rest of it that still needs to work. And I'm sure we'll have the rest of this discussion to talk through that.
Awesome, Anthony. Thank you very much. Ezekiel, please go ahead. And I'm a little bit jealous about the Californian sun in your background also.
Thank you. Yes, my name's Ezekiel Kopik, or Zeke for short. Ezekiel can sometimes be a bit cumbersome. Anyway, I work for a company called C Labs, which is, as Valentin had mentioned, where we built the Celo blockchain. But prior to that, most of my career has actually been spent in central banking. So for many years, I was at this Federal Reserve Bank in New York. And then after leaving that, I went to the World Gold Council for a while to help central banks around the world manage their gold reserves. So I really sort of take this challenge on, more from perhaps Martin's position. I mean, certainly I'm not a central banker anymore, and he has challenges that I couldn't even dream of now. But certainly looking at how we can create these public and private partnerships between central banks and between technology partners, because I ultimately think that's really the way forward. I don't think there's a one size fits all for CBDC. I think that the solution that will ultimately perhaps work in the Euro area is not going to be one that perhaps we'll see maybe in the US or in other parts of the world. So I think that it really comes down to understanding how we can work together in the private sector and the public sector, whether that's, using wholesale CBDCs to back stable coins that are maybe privately issued, which is somewhat akin to our commercial bank money that we have now, is certainly one option. And for us, we're really focused also on interoperability. There's a lot of great blockchain projects out there that are doing a lot of really cool stuff. And I think for me, if I just put my user hat on and not a member of a technology company, I want to be able to make sure that if there is a CBDC out there, that like I might be able to use that in all these amazing, decentralized financial products, whether they be on Celo or perhaps on Ripple or perhaps on any other blockchain. And so, as Anthony mentioned, like this is a very complex situation, and it's, we're not going to get there tomorrow, and it's going to take, quite a while to do. But I think with sort of this public partnership, with these dialogues that we're having, is also really important. So I'm very excited to be here and look forward to the conversation.
Thank you very much. And last but not least, Peter.
Yes, hello. Yeah, thank you very much for inviting me to this discussion. And so I got in this business about 40 years ago when I wrote my dissertation, and the dissertation was on a paper by Friedrich Hayek, which had the title Denationalization of Money. And so he was the first one who made the case for private money competition. And so I wrote this dissertation about 40 years.
Peter, we have some connection issues, which is a pity because Hayek's denationalization is a very great topic to talk about.
Is it better now? So I've put off the. Is it better? I've put off the camera.
Yes, it's better. You can start with Hayek again.
Okay, so I came with, so my starting point was Hayek's proposal for competition, private competition in money, and I wrote the dissertation in early 1980s. But then for many years nothing happened, and so of course it's fascinating for me that now all the ideas that Hayek had, that private issuers of money compete with the national issuers, that has now become reality, and so that's, to me, it's really fascinating. So what is my approach to the CBDC and digital euro debate? So under economists, most of the discussions are from a macroeconomic perspective. So how does CBDC impact on the transmission process of monetary policy? Will there be disintermediation among banks and all that stuff? And so my approach is more microeconomic. And I addressed the discussion from two aspects. And one aspect is, if the central bank as a public institution enters into the competition on the private markets, there must be a market failure. As economists, whenever the government becomes active, we say there must be market failure, because otherwise the government should keep out. I think that's the Hayek idea, saying we need private competition, we don't need the central bank to be in this business. So the one question to me is, where is the market failure that justifies the activities of central banks now going beyond just issuing cash? And related question to this is, if central banks issue CBDC, will these CBDCs be able to compete successfully on the market? Because so far central banks are issuers of monopolistic issuers of cash. There's nobody else competing in the area of cash. But with digital money, central banks, of course, compete with other digital solutions. And to me, the important question is, will central banks really be successful with CBDC, or will it become a gigantic flop, which would have negative impact on the reputation of central banks?
Thank you very much, Peter. Yeah, I think you can see that you are well-deserved one of the first experts we had at the DEA. You guys mentioned so many topics that go into the core of this discussion: wholesale CBDC, public-private partnerships, stablecoins, Hayek. I would invite one high-level round of why do we need a CBDC? What are the benefits of a digital euro before we dive into these topics one by one? So yeah, can we have one round more about like why are we talking about a CBDC? In the same direction, maybe Martin, you want to start?
Yes, of course. Thank you very much, Valentin. We first have to discuss what it really means, digital money. I mean, digital money we have since 70s, since the 80s. Every one of us has that on his account or her account. This is nothing really new. Digital in means of electronics and not being physical. But digital nowadays means something more, something different. It must be more than just being non-cash. Every one of us knows that. And digital or central bank digital currency must also be more than just money on an account with a central bank, like money with Target 2, which only banks can have, or our business partners have, which is limited to them. Though in our eyes, we have various publications explained by the Bundesbank, digital in the new sense means more. It must have something to do with the new technology related to blockchain and DLT. It must serve some of the purpose or the functions which were enabled by DLT or by blockchain. So these are the functions of mainly programmability in a way. And this is the aspect we found most useful in the inventions of Bitcoin and all related inventions afterwards. Bitcoin itself was important only for the network. We don't look too much at the cryptocurrency. It doesn't. Sorry for the word, for the crypto token. It's not a currency, as you all know. So we don't look too much on those crypto tokens. We look at the technology, and the main benefit of the technology is it could serve us to create something what we call economy 4.0. It could serve us to make smart contract work in order to facilitate the automated settlement of trade, of every sort of trade. And it could serve us to make use of DLT, giving the economy a means to use a joint database for that trade. So this is the main important here. Whether we need new money, well, it could be needed if we want to make that DLT really work in an economy. That is our view from the Bundesbank. So programmability is the most important aspect here. There is another aspect which comes more from the political sphere. It is about sovereignty. We consider nowadays the payment system and the settlement system as a strategic sector of our economy. And if the European Union or the Monetary Union wants to create or to support a European sovereignty in all strategic sectors, then we need to base our infrastructures on European institutions which follow our European guidelines. Nowadays, as you all know, our payment system is, it is European in a way, but transnational payments for private households or for companies are very often routed through non-European based institutions, MasterCard, Visa, whatever. We don't have any problem with MasterCard or Visa, but this is not a European institution. So here we have some limits for our oversight, for our sovereignty. So a digital euro could also be a backbone for European sovereignty when it comes to a strategic sector, payment system, or settlement system. So these are, in my eyes, important aspects for thinking about it. we might be forced, or not really forced, but we might be inclined to implement really a digital euro at one day in order to defend our sovereignty, to defend it against whoever, against other countries initiating a digital currency, or against private companies creating private money, which may be used also in Europe. And in order to be prepared, it is worth thinking about the digital euro. I'm not arguing that I would implement it at the moment, or that we have already found all the necessary means how to implement it. But I'm arguing for the fact it is necessary to be prepared in the case we need digital euro.
Thank you very much, Martin. Anthony, do you want to answer or talk about CBDC in general again?
Yeah. So similar to Martin's sort of points and sort of where we tend to look at with Ripple is sort of the use cases and the benefits of a CBDC. So why are the citizens, why are the businesses going to use this, as well as obviously the sort of other side of the coin. So we've got 5 sort of main areas we look at. One is the obvious one around enhancing existing payment systems and payments infrastructure. So with a CBDC, hopefully, it will be faster, more efficient, reduce cost, less failure. So it's just a lot more efficient to make payments, and also micro payments and those sorts of things. So just the main basics of an improved financial payment system. I think secondly, and something that's mentioned a lot globally when you talk about CBDCs, is financial inclusion. There's a lot of countries around the world, and even countries in Europe, where there's a significant proportion of the population which is unbanked or underbanked. And using a CBDC, assuming that everybody has a smartphone or some type of even a text phone, could actually promote the financial inclusion a lot better. And also for times like we've just been through, with COVID, payments to the people quickly have been very difficult. I worked with Ireland at the start of the pandemic, and it was quite difficult for them to make payments to the businesses and people as and when they needed it. And I think most countries had similar issues, and obviously the US actually sent out checks and pieces of paper. So we need to get a system whereby hopefully not, well, it's probably will be when the next pandemic, but the next crisis hits, we're in a situation where the banks and governments, the central bank and government, can help the people instantly, in essence. The next one is around competition and co-opetition, and really reducing the barriers to entry of payments and payment related, and working together. So one of the things that a CBDC would do is help people use payments in a quicker, easier, smarter way. And that then brings us to innovation. And innovation is just, totally, beyond our imagination, I think. I mentioned at the start NFTs. A year ago, I'm sure most people would be, what is NFT? What does it mean? Now we all know a picture of a monkey is worth millions and millions of dollars at the moment. But that type of innovation, which is happening in, the crypto markets, the fintech markets, and just generally, a CBDC would really help that with quick settlement and, transparency and openness. And then finally, and really to Martin's point, it is around the CBDC is around maintaining control and sovereignty for the central banks, but also transparency and, understanding what transparency means is a big discussion. I won't go into that now. Obviously, I assume we will later on. But, so it enables transparency the way that the government of that country would want. And I think, that's important for different countries in different ways. So yeah. So I think those are sort of the main 5 areas that I see why a CBDC is important. And in Europe, as I said at the start, it's a lot of different countries, and we all use the same currency, so we've got to actually work together and sort of work the best for everyone, which is the challenge ahead.
Yeah, thank you very much. And I think the audience already gets why we were internally so excited about this panel. Let's complete this round with Ezekiel. Maybe you go ahead.
Sure, thanks. Yeah, I mean, look, I agree with, what's been said by Martin and Anthony. But I think, taking a step back, I think we should probably, make sure that we're defining what we mean by CBDC, because, there's wholesale versions and retail, versions. And I do think that those are different and separate. So you can, to Martin's point about sovereignty, I could see a situation where, Europe might want to go more of a wholesale route and use that sovereignty through a wholesale CBDC, where other countries, maybe want to do that through retail. So I think we do want to make sure that, when we're talking about the benefits or the pros and cons of a CBDC, we want to make sure we define that. Because you can imagine, like, what really is CBDC compared to a stable coin? The biggest thing for me is that CBDC sort of represents that trust that a central bank will often have. The citizens of that country will always often have, all else being equal, they will trust their central bank over a private sector payment system, right? And so, in Europe, there's already a very strong banking system. Most people have access to banks, not everyone, of course, but most people. And so, while certainly, financial inclusion is a big, part of that. I think that doesn't necessarily come into play as much as in other parts of the world, in emerging market parts of the world, right? Where those commercial systems, those commercial banking systems may not be as robust. Their ability to bank their citizens may not be as vibrant as it is in other countries. And so there you could argue that a CBDC on a retail side might be more important, especially to Martin's point about sovereignty. Right now, the vast majority of stable coins are pegged to the US dollar, with then some, being pegged to the euro, and then lesser ones to the British pound and the yen and stuff like that. And so you can imagine for smaller countries, smaller central banks, right? The last thing they really want to do is have this, big stable coin come in that's pegged to the dollar, and all of their economy is now becoming dollarized, before their very eyes. And so, I'm certainly, understanding of that perspective. And so you can see there, they would want to have a retail CBDC, right? They'd want to have an option that was denominated in their local currency. And that's really, really important. I think for places like the US and Europe, a lot of these digital currencies can already be in their local currency, right? There are stable coins pegged to the euro. There, again, obviously, most of them are pegged to the dollar. So that's not necessarily an issue. And then once you get kind of past that, then of course it's all about the use cases and, the programmability of money, and absolutely, the financial inclusion. One of the things I'm really excited about is the ability to do things that our current traditional financial system, it's just really not in their business model. When you think about like micro payments, there's a company building on Cello that, delivers universal basic income, like in the denominations of like 50 cents a day to people all over the world. You can't really do that right now with our traditional financial systems. Like, they're in 30 countries, they're in thousands of communities, they're distributing millions of dollars, but at 50 cents, a transaction. That's not possible in our current system. Or you think about the use case of microinsurance, right? Our insurance companies probably don't want to worry about insuring somebody's small land and crops that might be worth, $10 or $100 or whatever, right? They're kind of more focused on the bigger players. And so this ability to really have, focusing on the individual is such a powerful tool. It's a really exciting thing. So.
Yeah, thank you very much. Peter, may you complete this round?
Yeah, thank you. So I must say, I'm still not so convinced that there is a good business case for the digital euro. And I think one has to differentiate among two dimensions. One dimension is you can define the digital euro as a payment object or payment asset. Simply that you are able to have a bank account with the central bank. So that's the payment asset. And what is the advantage of having an account with the central bank? Well, the only advantage, but of course important advantage, is that the money is 100% safe. And in fact, people from the ECB also say, yes, the case for the digital euro rests on the idea that people must have access to central bank money, even if there's no more cash. And so, yes, there's some interest in this absolutely safe asset, but it's limited because up to 100,000 euros, you have the deposit insurance. So any account with the commercial bank is also safe. So what's interesting are deposits above 100,000 euros. And there, of course, the interest would be huge. I think there would be many investors, global, national, foreign, that would be happy if they could deposit money with the ECB. But that's exactly what the ECB doesn't want. So this is something that would be really attractive. The ECB clearly says more than 3,000 euro will not be possible. 3,000 euro, that's just peanuts. So I think this kind of payment asset is not really interesting. Then you could say, well, but it's a kind of digital form of cash, this digital euro. But the question is such a digital form of cash really interesting? I often compare it to wine without alcohol. So in Sweden, for instance, you can get wine without alcohol because alcohol is so expensive. But I think normally what makes wine attractive is the alcohol. And what makes cash attractive is that it is not digital. Yeah, and so this kind of digital cash, that's what the digital euro might be, in my view, is not really so much attractive for most people because they have a reason for not using the easy forms of making payments in an additional way. So I don't see why people might be really interested in these payment objects. Then you could say, well, digital euro is a payment system. It's a complete payment system. And that's what, when people talk about the sovereignty, as Martin did, of Europe in relation with these United States payments platforms, there could be a case for that. You'd say, yes, we do not want PayPal to dominate our payments, which they are increasingly doing. But the question then is, if you want a European retail payment system that competes with PayPal, do we need CBDC? And here I have a very good example. In Switzerland, you have Twint. That's a Swiss payment system, retail payment system, which is extremely successful and which is even able to limit the power of PayPal. So in Switzerland, you have much less influence of these US payment platforms because they have Twint. So they've developed their own payment platform, but this Twint payment platform does not even have payment objects that are specifically of this payment platform. The payment platform just uses all kinds of payment assets. So I think it's not so clear what the advantage of the digital euro is, and I don't see right now that the ECB has the ambition to develop a complete retail payment system. And I must say I also doubt whether a public administration, a central bank, would be creative enough to develop all these nice features that you need to be successful on this area. So I have many question marks.
Yeah, thanks. Before we dive into this very interesting topic of like public-private partnerships, Martin, I saw your reaction when Peter mentioned the direct access to central bank money, which would basically be a retail CBDC. Maybe now where we have you on the panel, could you maybe explain why this retail CBDC is so different from a wholesale CBDC and why the ECB is as hesitant to provide this?
Yeah, in part, of course, Peter is exactly right here. Or let's put it very simple. There are some who have argued, even central bankers, but I don't want to give you a name or to blame anyone. Some have argued that we need a digital form of cash because people are using less and less cash. Well, as an economist, I would say if people use less cash, so why do we need a substitute for cash? If they don't want it, so don't give it to them. The Euro system has made it very clear, and also the Bundesbank, that we do not intend to substitute cash. cash is issued as long as cash is demanded. So the argument we need something to substitute for cash is not really valid in my eyes. That is not the case. The case must be drawn, as others also have argued in this round, on the new possibilities of this technology, on what is really new now, what has changed. And the thing what has changed is we have a new technology at hand, which facilitates a lot of more, things which haven't been possible yet. That's why I'm talking about programmability. The other aspect of sovereignty, which I mentioned, has not changed. It is a long-standing European issue. The case of Switzerland is, I know that, Kate, but Switzerland is only one country. Within Germany, we have also a very good system, very cheap for the customer, the Giro card system, but it ends at the border of Germany. Outside of Germany, if you pay with your card, the payment is wired via any credit card company. This is not a European-based system, though this is different. The new aspect is really the programmability, and that's where we come to the point what we need, why I'm talking about wholesale CBDC as probably the more urgent use case. A retail CBDC would be something at hand for all people, possibly all companies, for everyone. Everyone who could get cash could also get a retail CBDC. Wholesale, well, there are various definitions. The best definition in my eyes is restricting the CBDC, the wholesale CBDC, to those who have already nowadays access to non-cash central bank money, meaning those who have already an account with the Euro system, with Bundesbank or any national central bank, who have an account at Target 2. Well, why is that difference so important? It has been for me, the most striking difference. If we limit the issuance of CBDC to those who have already access to nowadays non-cash central bank money, then we don't have any implications for monetary policy or financial stability. If we allow the broad public, private, non-financial companies, private households also to get central bank money, we might induce the disintermediation of the financial system Peter and others have talked about. This is the biggest economic risk I see. We don't know exactly how it will turn out. Now, as a central banker, it is not my or our objective to keep the banks alive as they are nowadays. But we have to face the fact that a large-scale disintermediation and large-scale starts already at double-digit numbers. If you withdraw 10% of the deposit of the bank, this is a significant shift in their balance sheet. This means a significant shift in their business model. This means a significant risk for financial stability. And we don't know exactly how that will turn out, how we will guarantee the stability of the financial system, neither in the subsequent steady state and when it will be achieved, nor in the transitory period. These are significant risks. That is why the Bundesbank always argued limiting it to wholesale CBDC is much more easy, involves much less risk. Now, you know that the Euro system is at the moment in an investigation phase about the digital euro, talking about a retail CBDC. So developing models how to limit the potential disintermediation is our biggest task in my eyes, and we are really working hard on it to find solution. I'm not blaming anyone. I think we are far from a solution at the moment. So this is about the difference between those two.
May I ask a short question? May I just ask a short question to Martin? What is the difference then between a wholesale CBDC and traditional central bank reserves?
Yeah, very good. Very good question. Traditional central bank reserves are not able to be used for a settlement on the DLT. our industry, our financial companies are increasingly using or trying to use that are proof of concept, that are prototype for the use of a DLT as a settlement technology. This is, well, an important strain of work there. DLT allows, as I said at the beginning, for two important advantages. First, the use of smart contracts, which could, well, enable the industry to settle complicated transaction automatically if it is pre-coded, and so it could reduce significantly the transaction costs in our economy. And second, settling on DLT what means that all participants use the same database. So reconciliation cost, the cost of checking, well, I recorded that I have bought so much shares, and you recorded I have only bought so much, and then you found out later, well, what is the correct one? All those reconciliation aspects, which are, according to some estimates, 70 to 80% of the back office cost in central securities depositories, in other financial market infrastructures, and also with companies. They could be reduced significantly if we have only one database for those complicated trades. And if they want to use a DLT, then they at best need tokenized money. Now, if we don't want or are not able to issue tokenized money, which we are far from, it would take some years still, a couple of years, then there are other options like a trigger solution also, or something like that. But we as a central bank should strive to enable the use of a DLT for the economy. But clearly, this is nothing for the small scale shop at the corner or the private household. They don't use DLT. I don't see that.
Thank you very much. And I knew 2022 would start very great, but I didn't know that this would mean in February having Dr. Martin Diehl of the Deutsche Bundesbank explaining the benefits of a DLT solution at the DEA panel. I'm very thrilled about that. Okay, now where we differentiated between like a wholesale CBDC and the current financial system, Zeke, I want to ask you as a former central banker and now as a, you work at a company that provides stable coins, right? And stable coins are the solution on a DLT, which obviously has a lot of benefits to, deliver a stable value. So, I would ask you to like answer or respond on what Martin said, and maybe actually bring the stablecoin company view towards regulation of a wholesale CBDC.
Sure. Yeah. I mean, I appreciate Martin's comments. I guess I would push back a tiny bit in the sense that, I certainly agree with Martin that we wouldn't want to give households, for example, access to central bank reserves. And that's this argument, for direct CBDCs, what they call it. I mean, central banks were not designed to be retail banks. But where I would push back a little bit is if we keep the central banking system and the reserve system only for banks, we're basically keeping the same system that we have. And the reality is that the innovation, unfortunately, didn't come from the traditional banking sector. It didn't come from central banks. It came from private companies. I'm not saying that private companies are perfect. They obviously have issues they're working through, and it's an iterative process. What I would argue is, one of the ways in which we might be able to partner is if a central bank were to say, okay, look, like we are willing to give some stablecoin providers that we have been able to say vet, it's not going to be everybody, access to this wholesale CBDC, for example, because you could argue that, what the private sector is really good at is innovating, right? And what the central bank is really good at is building trust and creating this trust. And so if you combine the two, in my eyes, you have a really powerful product. If there was a wholesale CBDC that was able to be used to back stablecoin providers in Europe, right? Let's just say there are 5. I don't actually have a number. I don't really know. but if those stablecoin providers could all back their stablecoin with wholesale CBDC, either one for one, right, and essentially be creating a narrow bank, or even do sort of the commercial bank model where it's maybe fractional reserves, right, where they have 50% of their reserves are in a wholesale CBDC issued by the ECB. Then you create a system where as a user, it's more of a market-based approach, right? Like I might choose stablecoin A versus stablecoin B because they have better functionality, or they have a better user experience, or they have a better network, or whatever it is. And so, because my concern, right, and Peter brought this up too, is that central banks are not good at innovating. If they build a CBDC and they just sort of leave it static, they may not have that innovation. But people might still come to them because it is the central bank. And I'm less concerned. And in this model, certainly there could be some bank disintermediation, but on some level, I actually think that's a good thing because it's more market competition. It's not saying that everybody's going to drain their deposits at the commercial banking institutions and only hold CBDC at the central bank. Like I agree, that wouldn't be a very good solution, right? I mean, that'd be like all of us taking all of our money and just putting it in cash and putting it under the mattress. From an economic perspective, that's a terrible idea. From a central banking perspective, not a great idea. But if you can combine the two, right? Combine this trust that we have in central banks with the innovation of stablecoin providers, then I think you could have a system where people can really get a lot of value out of this. And so, I would like to see, a time and place where, non-banks are able to have access to a wholesale CBDC to allow them to then use that for their own stable coins. That to me would be really interesting.
Well, may I directly respond?
Absolutely, that'd be great.
Thank
Yes.
you. You must differentiate. What does it mean having access to central bank money? Having access to central bank money means you can use it within the system of the central bank. You can transfer money within Target 2 from one participant in Target 2 to another. These are mostly banks, not only banks. There are also financial market infrastructure, something like that. It is not to be used for outside purpose. If we talk about the non-financial companies or private household, then they deal always with commercial bank money. Also, the banks have access to central bank money. Now, I'm not sure exactly what the last stance of the governing council of the Euro system is, but it used to be our policy that we let central bank money only circulate in central bank systems. Well, why is that important? Well, as you mentioned, we rely on the trust in central bank money. The trust of the people of the market is the only important aspect for us. It's our only asset we have, basically. If we let our money circulate in private system, we run always the danger of reputational risk and more. So that's why we finally, with the implementation of Target 2 securities, avoided that any private institution runs central bank money on their account. If you want to have central bank money, it is an obligation for us. It should be run in our system. That is why we are a little bit careful. Issuing wholesale CBDC would also mean that we have some control in the system, running at least a node on the DLT or whatsoever being in that system. But providing central bank money as a backup for a stable coin is something I could not imagine to be done, because then this stable coin company would issue something which could be considered as being like central bank money. And if something goes wrong, it could endanger our reputational risk. It must be very clear what is commercial bank money and what is e-money and what is whatever money funds, something like that. Stable coin should make sure that they have an own risk, and that everyone who uses a stable coin has the risk of the stable coin, of the company issuing the stable coin. That's why I cannot imagine that, really.
I guess I'd push back a little bit in the sense that, like, first of all, I agree that, like, if a central bank were to issue wholesale CBDC and it would be issued to a stablecoin provider, that money is not then, that wholesale CBDC is not going to be accessible to a household, right? What you're doing is you're basically expanding the central bank network by a very small amount by allowing the stablecoin provider to be in the network. The wholesale CBDC never would leave the network itself, right? Again, it would be used to back a stable coin, right? Another, like a stable coin pegged to the euro, something like that. Now, your question about the reputational risk, I certainly understand it and appreciate it. I guess my question though is, like, this model is no different than what banks do, right? Banks hold central bank reserves and they issue their own commercial money. Now, when a bank goes bust and when a bank fails, as we all saw in 2008 and all that stuff, no one blamed the ECB. There wasn't really, it wasn't the ECB's problem, or when, things in the banking system in the US, right? No one blamed the Fed because of the fact that these companies were backed by central bank money. And so I don't know that you could necessarily say that if a stablecoin provider was backing their stablecoin with a wholesale CBDC issued by the ECB, if they went bust, I'm not entirely sure that you could blame the ECB for that. I also think it would be a much safer way, for example, having that money be basically in the central banking system, to me seems far safer than having that stablecoin provider put their money in a commercial bank where there's zero transparency, where we have no idea what they're doing. And so at least if it was in the central bank, you as the central bank would have full transparency into, like, stablecoin provider A and B and C and what's in their accounts. And so for me, I don't know that I would necessarily buy the argument that the ECB should be worried about their own reputational risk. There's far more reputational risk if the ECB develops their own CBDC that's retail and that fails.
The answer to that is very simple. If you want to do the business of a bank, why don't you become a bank? We don't prevent you from doing so. Just become a bank, and you get access to target two.
Yeah, but I would argue, stablecoin providers don't provide loans, so we're not a bank, right? I mean, we're not transforming money. There's not this whole maturity transformation. We're not doing loans. We're simply providing a payment service. And so on that regards, I would argue that we're not really a bank. We're something else.
You would have to underlie this, the whole oversight of the central bank. The same rules would have to apply to you.
And I'm not suggesting that there shouldn't be oversight regulation. I mean, giving someone access to your wholesale CBDC should certainly come with some rules, right? And that's why not every stablecoin provider would sign up to get access to the wholesale CBDC, right? You'd say, listen, here are the rules, but those rules shouldn't be based on how big you are. I mean, you shouldn't be because you are, the biggest stablecoin out there and have maybe the most lobbying power. But you should say, look, here are the rules. If you can meet those rules, then you can have access to the stablecoin. And again, this is not maturity transformation, right? We're not taking that money and then creating loans out of it. And that's where the central bank should certainly be concerned about financial stability. But I don't know that I understand the argument for, against giving them access when it would really essentially be like a narrow banking system, which, in that case, we're not really like banks. But anyway, this is just, debate. So, I see others that want to chime in, so I don't want to monopolize time, but thank you.
Yeah, I think it's really interesting debate. For me, there's two things really. One is transparency, and both of you guys have just mentioned that. What a CBDC on DLT does is give transparency. So whichever level you go to, you can have transparency. So if you look at the ultimate, a retail CBDC all the way through, not necessarily without intermediaries and without the commercial banks, at one press of a button, let's call it, you can see all the money everywhere, like where it is, payment providers, commercial banks, central banks, etc. So I think transparency in the ultimate aim, that doesn't happen overnight. That's obviously where it can get to. So I think that's important. I think the stablecoin thing is really interesting because there's lots of discussion about it. The reality is there's billions of dollars in stablecoins today. So if you're a country and your citizens are high crypto users, they're probably at the moment in, I don't know, 50% stablecoin. You know, the market's not great. So depending where we are in the market, depends on, you know, where people are trading the stablecoin. They are all, as Zeke said before, they're all in US dollar, really, a few euros, etc. Isn't that a massive risk for smaller countries and for Europe overall as euro? Because I personally live in Europe, pay my taxes in Europe, and I have my stablecoin in US dollars. Most of it is in US dollars at the moment. And so when this starts to grow, which is growing, as we know, exponentially and will continue to grow, then the risk of this is just growing every day, every time this grows. So for me, looking at a stablecoin in the family of the CBDC, let's call it, I'm not sure exactly how linked, but in that family is really critical to this. And, you know, we were talking to a couple of non-Euro European central banks, and they brought up this sort of discussion that actually they've got very high crypto usage, and they're very concerned that in their own currency, which is non-Euro, but in Europe, they're all in US dollar. And it's quite a lot of money in their economy that's sort of sat in somebody else's currency. So they would want a stable coin in their currency straight away as part of this, but they want the oversight and to be able to see it. So I think the pressure is coming from the crypto trading that we have to look at this. And for me, the transparency that we can have as an overall CBDC, let's call it family, I think is the ultimate aim, but it's still the building blocks to get to that.
I think a stable coin and CBDC is just the opposite, because CBDC would be 100% safe. And I think stablecoin is a relatively unsafe form. It's a kind of
Peter, could you turn off your camera, please, because of the connection? Thank you.
So now,
perfect.
So I think there's difference between CBDC. You don't hear me? You
kind of.
Don't get it. Maybe try again.
I'm afraid the connection is pretty bad. I would actually love to hear your statement. I'm not sure if it gets better. I will come back otherwise in a minute.
Maybe I try.
Nah, no, this doesn't make sense. I think this is too digital, too much Robert right now.
Yeah.
But I would really love to hear you.
I'll jump in later, okay? Maybe then it's better. Go ahead. Okay, go ahead.
I mean, sometimes it's working, right? We all know this from Zoom and from the bad connections, especially after more than 2 years of pandemic. Is it working right now, Peter?
I think he said to move on. He's going to try. I think he's probably resetting.
Yes. So we have this very, very interesting discussion, right? I think we're at the core of the actual discussion. So we're having obviously the central bank being concerned about financial stability, and for God's sake, because like we all benefit like highly from financial stability. And I also found it very interesting that yes, disintermediation is a topic, but this is obviously not the it's not the goal of the central bank to preserve private banks. but also allow for like market competition. But I also found it like very interesting to have this like very strong viewpoint of a stable coin, because a stable coin obviously in this in the system wants to get market access to, and there's arguably like you can have the position of like, hey, this is maybe an unfair access barrier, but I think there's a proposed solution to become a bank, right? To get a private banking license, and then like get the access to for example Target 2 or like CBDC or sorry, to central bank money. And then we have the question is what is wholesale CBDC? So it's basically like a new technology for the interbanking market, or Martin, you're shaking your head.
No, sorry. Let me start one aspect former. I come to your question. Don't worry. Stable coins. What are stable coins at the moment? Stable coins have reacted to the fact that crypto tokens like Bitcoin and the like are extremely volatile. They are so volatile that they are not usable for payments nor for savings, only for speculative aspect, really. And though some people argued we need a crypto token which is stable. And there are various forms of various trials to make them stable. And the only way which really works, to my knowledge at the moment, is pegging the value of a coin to a real currency, US dollar in most cases, or to the euro, pegging it to that, and underlying the amount of stablecoin with the same amount of that real currency, or by US dollar or euro. This is the only way, obviously, which really works to stabilize a crypto token. So stable coins are only stable because they rely on central bank money. This is a big compliment to central banks. I take it. Sorry for that.
Good one, yeah.
Though what is really new to stablecoins? Well, they are stable and they run on a crypto network. Now, coming back to one aspect which was mentioned by Ezekiel, he mentioned at the beginning something like it is faster and it is cheaper than our current payment system. Now, doing analysis in payment system, I know very well that we have some really, in some cases, it takes a long time and it is really expensive. Cross-border payment is not that good. But there's a big but. Decentralized networks are only in a very few cases cheaper, and they do not, they are not really to compare to a real system. In technical terms, there is nothing as efficient as a centralized system. We did those experiments. Decentralized system always involved a little bit more time and a little bit more processing power unit than a centralized system because of the consensus mechanism. Only if you get rid of the consensus mechanism, which would be a centralized system, then you have the same physical cost. Second point, all those crypto networks or stablecoin networks, besides a very few, they do not care for know your customer rules or for anti-money laundering laws or for anti-terrorist financing laws. Payment is not costly. Normal payment system is not costly because the electricity is so costly or the banks make so much profits out of it. The biggest aspect in the cost is safeguarding against money laundering, safeguarding against terrorist financing. If we would require Bitcoin, Ethereum, and all those networks also to run the same protection against money laundering, it would be much, much more costly than it is nowadays. If we want them to do the payments for us, they need to, basically. At the moment, they are free from that. We have only money laundering at the point when you exchange Bitcoin into euro, then the money laundering laws acquire. In my eyes, this is not sufficient, but this is my very personal view. Okay, so it is not cheaper. I know we could improve our system. I know we could improve also by using DLT. DLT itself as a technology is not good when it comes to simply transferring one value from one person to another. Its biggest advantage comes when you transfer values, when you settle values, and you have some after sales business like security settlement. Then you have a lot of whatever, you have dividend payment, you have split of shares and so on. And then you need the second database, and you have so more business with it than just the simple transfer. For the simple transfer, as I said, there is nothing as efficient as a centralized system. Okay, DLT is good when you have more complicated issues like security settlement or settlement of, I don't know, complicated international trade and so on. And there we need that. Okay, and now we come again to wholesale. What is wholesale money, or what could wholesale money be? Well, there are at least two competing definitions. One is wholesale money is when it involves large values. That is an easy definition, and don't mix it up with the other definition. The other definition is what we central bankers like more. Wholesale CBDC would be CBDC accessible only by those who have already nowadays access to non-cash central bank, who have already nowadays an account with Target 2. In the second case, if the definition applies, we would argue there are very little risk in comparison to retail CBDC. Retail CBDC would be digital central bank money available for all who can nowadays have access to cash, basically to everyone. That would be retail, for every person, every single person, and every single company. Wholesale would be only to the banks and a few others who have access to those accounts. This is, from a central banker in our division, the less risky version. But there are also others who argue that for really using DLT, we might also look to large companies who have large value transactions, and they also need some access to central bank money, to digital central bank money. I know that the Bank of England has a different stance here. We have not publicly considered that from the Euro system. We might do so in some time, but I'm not promising anything here. Okay.
May I ask a question?
Let's try again, Peter. Yeah.
Do you have now an idea to have the central bank as two separate payments? One on Target 2 and the other one on a distributed ledger. Is this your vision?
Let me directly respond. This is possible, of course. It is possible to have a separate system if we want to enable financial and non-financial companies maybe to use any form of tokenized central bank money for the settlement in DLT. We might be forced to run a second system. However, there is a second option, which I call the trigger solution, or we call it the trigger solution. We have the idea that we could enable the financial companies or others to use DLT and at the same time build a technical bridge to the current conventional payment system, in our case to Target 2. So if you have like securities trade, you know that it is now, since June last year, it is possible to issue electronic securities. The electronic securities could be issued directly onto a DLT and could be traded directly on a DLT. But the cash leg of that settlement, the asset leg would be on the DLT. The cash leg needs either tokenized money or access to a payment system. So we built a bridge, a technical bridge in our experiment together with Deutsche Börse and the Finance Authority of Germany, and they issued a fictional electronic bond on that DLT, and it was settled via this technical bridge, which we call trigger solution, in target 2. And then the Bundesbank reported back, money has been transferred, and then the security transfer finally took place. So it was a DVP, not within a logical second, but in an economic DVP on the DLT, in a sense that the electronic security changed ownership only if and only if the money has changed. The central bank money has changed ownership. And the central bank money has changed ownership if and only if the electronic security has changed ownership. This is possible, and we are currently thinking, discussing in the Eurosystem whether we should implement such a solution, which would be much faster than issuing wholesale CBDC, and it would be much less risky because we don't run an own DLT here. We only provide a new access to target 2, and central bank money is kept in target 2. This is also better for the liquidity management of banks because they have only one account. It doesn't incur only banks. Though there are other solutions than running a whole DLT where we could learn about the use of wholesale CBDC and maybe could still work on wholesale CBDC to issue it in the future. But this is only under discussion in the Eurosystem. There is not a decision been taken on that.
That's interesting. How fast were the settlements in your experiments?
In our experiments, due to the setup and to the use of a test system, the test system doesn't have the full power of the whole system. It took 2 to 3 minutes. I think we could limit to that between a minute, below a minute. This is, of course, only for large value transaction. And as I said, I still believe, and I think Peter agrees with that, normal households don't use DLT for everyday trade.
Yeah.
On the retail side, we don't need that. Yeah,
I think everybody that tried to onboard a friend or maybe even a mom to DLT will agree. And I just want to give Zeke a short minute to answer if the trigger solution is feasible from a stablecoin view. And yeah, in the next round, I would refer the first audience question to Anthony, because we are approaching the last 15 minutes of this super interesting talk, and obviously the DA wants to invite audience questions. I've seen a lot of questions, so maybe Zeke, maybe you complete this discussion round between us.
Sure. Yeah. I mean, look, I think certainly the trigger solution is an interesting one that we can look at. I think to the point, though, again, stablecoins are really focused on the retail user. I mean, they were created to allow retail users access to digital payments that maybe they didn't have access to because maybe they didn't have a bank account. So I don't know. Obviously, I think stablecoins can be part of this world in the wholesale side, and can be part of the securities side and moving. I personally think that all these assets are going to come to a blockchain at some point, just because of the efficiency. I have to say, I don't think I said that they were faster and cheaper. I believe that was Anthony, although I do agree with him, Martin, that I do think that they're faster and cheaper. So let's give Anthony credit for that one. But I do want to push back a little bit. I take a little issue with this idea that stable coins are this realm of criminality and that none of us do KYC. A lot of us are very responsible in this field. A lot of us, I mean, our reputations are at stake as well. I mean, we don't have as great of reputation as the Bundesbank, of course, but if we are all of a sudden known as fraudulent and criminal, like you can imagine, we wouldn't last very long. So we take great pride, as do a lot of others, in making sure that we, find ways of doing this. There are KYC over certain limits, right? So, and this is what a lot of central banks are doing right now, right? So I would push back a little bit, right? I mean, certainly there are cases of this, obviously, but I would argue that maybe not so much in the stable coin world, at least not the world that I'm a part of. But yeah, I mean, I think that as it goes to trigger 2, again, I mean, we would love to be involved in these discussions, because I think that the private sector certainly has a lot to offer. But I know there are a lot of other questions. I know I don't want to, make sure that others have a chance to get involved, but thanks.
We definitely see that we could discuss for at least a few more hours, and the discussion isn't over. We will have some more years for this discussion, as it's ongoing, and I think it was very insightful already. So this is the first question that Zeke already kind of answered. It's from the audience. I don't see the name in the Zoom chat. It's and I would actually ask Anthony directly, because he mentioned this topic first. How exactly would CBDC increase financial inclusion, and what would attract unbanked people to use a CBDC instead of cash?
Okay, yeah. So financial inclusion works both ways in terms of, the example I gave in terms of dispersing money as a government in times of crisis. So on the assumption that everybody has a mobile phone or some type of electronic, device. So even in, Africa, Latam, etc., everybody has mobile phones which can text, etc. So if that's the lowest common denominator, anybody can access the financial system then. So if you that's the assumption that you make, basically. So they have a wallet on the phone or some sort of access codes. There's lots of actually quite interesting technology around that, so that they can access, so they can make payments to each other, P2P payments, pay their mobile phone bills, receive money from government, those sorts of things. So I think it's about financial inclusion from that perspective is about everybody has a mobile phone. Not everybody has a bank account for different reasons. Now, obviously, in Europe and America, most people do. And there's also, basic bank accounts, I think they call them in the UK and things like that. So most people have that, but actually globally, it's nowhere near as common. And also it's the usability. So for me, financial inclusion means, I use different, fintech banks with my phone. And I can just swipe things and do different things quite simply and easily. That on scale is what we need. So I think a couple of the guys on the call have already said that, there's fintech companies that are doing this, but they're all very small, very, they're for a certain type of people, let's say, for the more technology aware and technology adopting. So that's really, financial inclusion is the ability to get money to the people that need it when they need it, and for them to be able to access, normal, let's call it normal finance. Then you could also then talk about extra finance, and they could take out loans, etc., and make it even more inclusive that way.
Jump in here shortly. Okay. I think you have the and there's the M-Pesa system, which is wonderful for financial inclusion. It works nicely and offers many functionalities, but you don't need CBDC for it. So you only need a mobile phone network, and you need people who have mobile phones, but you don't need CBDC.
Exactly, but there's a number of
CBDC. That's my question.
Yeah, so there's a number of those solutions. M-Pesa, obviously, as you say, being one of the main ones that people know, but they're all around. They're all run by private companies, and they're only they have their different reasons for doing things, and the different, it's not trying to think of the words. If it was a CBDC related and the same as what I access through my bank account, then that's fine, but it's not. It's a different type of money. Now, I'm not saying it's wrong. It's just simpler and easier with the CBDC, and I think M-Pesa and those are actually leading the way. And if they were using a CBDC, they could still do what they do, but it would actually be quicker and easier and cheaper to settle, which is where it will get to, once we get more DLT in more of the, financial system.
I doubt this, because in order to compete with these mobile phone companies, the central banks would have to set up a mobile phone network, because that's what is required to reach the people somewhere in the jungle, and it's not. And so, in order to compete with these companies, you would need a network for this, because otherwise you simply take the CBDCs as another payment asset in this payment system, but CBDC would then be no payment system, because the system is a mobile phone system.
I'm not suggesting that the mobile companies don't do what they're doing today. They just access a central bank digital currency, which is a CBDC on DLT, which would be more efficient than the system we have now. Because at the moment, they're accessing the payment system and then through all the different levels and the different costs. So therefore, they can't do P2P very, ultimately cheaply. They can do it cheaper, but not very cheaply. So it's the CBDC that enables the mobile phone company to do things cheaper. And rather than getting rid of the mobile phone company, you wouldn't get rid of those. You wouldn't get rid of commercial banks.
I'm not convinced, but anyhow.
Cool.
Okay. Yeah. Again, I would love to continue this discussion. There's another question from the audience. I'm not quite sure how I would answer it. Maybe one of you guys, like we didn't even talk about public-private partnerships. The question, sorry, not the answer. The question is, do you think that the source code of the digital euro will be open source?
The answer is no.
Okay, perfect. So next question. I like that. What do you see as the biggest obstacle in scaling a CBDC that can balance audit functionality for AML purposes and privacy for consumers at the point of sale? So yeah, we have anti-money laundering, we have know your customers, like we've got this and we really want to have security and but then transparency, but then we also want to have privacy, and obviously there's a trade-off. Like, how do we balance it? Interesting. Who goes first? Who goes first, or who wants to answer? Yeah, perfect.
Without a question, is a balance, and this will be discussed forever, even when we move to the next stages of these sorts of things. I think in terms of speed of AML and KYC at point of sale, there's a lot of new technologies around there, and again, the private-public partnerships is where this would be good. So different ways of using your ID, your self-sovereign identity. For your wallets, for your phone, even fingerprints and things like that. So it's all about tying the transaction to the person. But does it need to be the person? Does the name need to be known? Because obviously with, cryptography, it's just a number. So you don't need to know unless you need to know who the person is. So the technology is more or less there, still needs a bit of work. There's a lot of testing needed for scale without question. But I think that's where the public-private would be really interesting to actually test this and see what information can be private, what's not private, what's shared with government, what isn't. But I'd definitely say it's there to be tested now.
Thank you very much. Maybe one last question. I think this is the next one. How do you see the role of a digital euro or other stable coin, interesting, as payment considering current contracts, payment legal obligations in banks like mortgages, sorry, in my English pronunciation. And I would maybe even add credit. So did you get this question? So I think it's actually about what is the difference between a stable coin and the bank, basically, and what is the role of a bank and how do stable coins fit in?
Let me try an easy answer. Also could add some more complicated aspect. Central bank money means it is a liability for the central bank. Cash is a liability for the central bank. It is in our balance sheet as a liability. And if you have central bank money on your, if a bank has money on her account with the central bank, it's also a liability for the central bank. Commercial bank money is a liability for the commercial bank. If you have a deposit with the commercial bank on your current account, then the bank has a liability and you have a claim on the commercial bank. Stable coins are sometimes structured as liabilities, not in all cases. That is the point, what I have been argued implicitly. All those stable coins companies must decide whether they want to become a bank, a commercial bank, then the banking rules would apply, and then they issue commercial bank money. Or they want to be so-called electronic money provider, then they fall under the rule of the e-money directive in Europe, which applies only to Europe. That there is nothing like that in the US. Or they could be considered a money market fund, then they fall under the rule of security law. They can decide whatever they want. Then the subsequent rules will apply, and then the money would be either like commercial bank money or like e-money, or it would be like a security claim. These are the choices they have. They would never be central bank money. That's for sure.
Zeke, last question to you. We apply to this, or we apply to machine-to-machine payments? The question was, where is it? So yeah, it's basically about CBDC. Will CBDCs provide machine-to-machine use cases? Will stablecoins provide a solution for M2M, which is basically machine-to-machine?
I mean, sure. Yeah. I mean, these payments can be applied machine to machine. I mean, just going back to the previous one, stable coins could be used to pay your mortgage if the person who has your loan is willing to accept them, right? I mean, at the end of the day, like, I pay my mortgage with commercial bank money. It's not central bank money, but my mortgage provider chooses to accept it for my bank account. It's not that, hard to imagine a future where that company would accept stablecoin for a payment of my mortgage, much like, machine to machine is super easy in that sense, right? I mean, it's programmable. You could have smart contracts, right? Where, you could have like energy usage, right? So instead of paying your energy bill, you could literally just pay it as you're using it, right? And you would never then get a bill at the end of the day, or at the end of the, the month, or whatever the period is. You would just simply be paying it as you're drawing down. So yeah, I mean, I think that's an easy one. Again, it's all about whether or not people will accept these things and whether or not they're useful. It's certainly stability and making sure that stablecoin provider is reputable, and all of those things that go on. But again, we choose banks in that way, and banks still fail. So there's not 100% guarantee in anything in life, really. All you can do is certainly do the best you can to make it secure and stable.
I must say that why don't you use just simple bank deposit? The bank has a clear legal obligation to repay you the money. You know I don't want it in stablecoins.
Yeah, if I have Peter's question right, I think he's asking why not use just a bank deposit. And the answer is great. Use a bank deposit if you have access to a bank. And I think that part of the frustration I have is that most of my conversations oftentimes are in developed worlds where we all have banks and we all have bank accounts. And sure, I can just use my bank account. There are so many people in this world who don't have access to traditional financial services. And so to say to them, just use a bank account, like, I think that misses the point. Like, they're not using stable coins because they want to use some fancy technology. In fact, they don't even really care about the technology. They're using stable coins because at the moment, these are the only companies who are willing and trying to reach them. Banks are not trying to reach them, maybe because of overhead and all of these other things. And so, yes, if they had a bank account, I'm sure they would choose a bank account over a stable coin. Maybe not. I don't know. But the fact of the matter is that they don't have access to those. And for us to sit here and say, choose a bank account, it's safer. I just, unfortunately, like, that's not the case for a lot of people. And so we're not focused on, Europe and the US. We're focused on trying to make things better for people in parts of the world that, their nearest bank is, 4 hours away. And things like that. So that's why I bristle a little bit at this idea that just use a bank account.
but they have these mobile phone systems which are quite efficient as far as I know.
Yeah.
And they are not based on stablecoins, they are based on kind of bank accounts in a sense. So it's a clear legal obligation that.
But not really though. I mean, M-Pesa is not based on a bank account. I mean, M-Pesa grew out of basically phone credits, right? Like that wasn't a bank account. I mean, that was like the equivalent of trading cigarettes in prison. You know, it's like you use what you have and you trade what you have. And so, you know, I'm just saying that, like, you know, it's not a bank account, right? And so they're using these credits to trade, and that became money, and that became, you know, effectively cash for them.
Okay, perfect. Again, really love this conversation, and yeah, obviously it's ongoing. Yeah, just looking at the time. Yeah, we started a little bit later, but still we are 5 minutes over our 90-minute panel, which is amazing. I am not quite sure, but I think it's actually the longest DEA panel that we ever had. And like for me, it was like for sure the most interesting one, actually. So I thank you very much. And I would ask you to, yeah, or I invite you for a last round. I hope our listeners have the patience to listen to you. I mean, you can always re-listen to the last part on YouTube. It will be available as long as the internet is available. And most of you guys are also part of our working group. So if you, if our listeners like really want to engage in the discussion, join the DEA. So yeah, how do we start? Maybe in the same order as at the beginning with Dr. Martin Diehl, head of section payment system analysis at Deutsche Bundesbank. A wrap up.
These are very interesting time, and we have seen the advent of a very new technology, which is going to change a lot in the terms of settlement of assets. For me, it is very fascinating because as someone who does analysis on settlement system, this has always been a back office topic. No one really cared about it. Now we have panels where 200 people listen. This is really fascinating. I've never seen so many people being interested in payment system as nowadays. Think really about what is new and how to make use of the new aspect. Not everyone who is new, not every institution will survive. The aspect of decentralization is, in my eyes, a bit overvalued. I'm not saying that because I'm working in a central bank, which is not decentral as the name claims, but I believe that trust will be important, especially trust in money. Don't bet against the central banks.
Thank you very much, Dr. Martin Diehl, Anthony Welfare, European CBDC lead in global partnerships of our new gold member. Thank you very much, Ripple.
Thank you. I'm still a little bit scared from Martin now. He said, don't bet against central banks. So I don't want to say anything now. So I think, no, as Martin says, and the panel says, I think there's some really interesting technology, and decentralized, centralized, it's a mix. It's not either or. It's going to be, there's a scale, there's a continuum, and it's not going to be either end of it. That's where we're going to end up. And I think for me, there's a lot of innovation out there. Learn about it, play with it, start to use it. And then secondly, it's about working together. Nobody's going to solve the digital euro alone. You know, this is going to be a massive number of partners, because you've got all the different central banks, all the commercial banks, all the payment providers, and then everyone else. So I think, you know, this is a big project where it needs to be open to working together, all different levels, all different parties. And the more we can do that, like the DEA is doing for us, the better this is going to be. So yeah, so, you know, great times ahead. So listen to these a lot more. There's going to be a lot more interesting ones. Thank you.
Yeah, thank you very much. Ziel Kopik, Global Head of Public Sector Research and Development at another partner of the DEA. Thank you for being here, C-Labs.
Great. Yeah, thank you. And look, thanks to all the panelists. I thoroughly enjoyed this discussion, and I certainly could probably keep going for a long time. Again, I appreciate the discussion. I think that, you know, as Anthony said, and Martin has picked up on, like, you know, this is a many-year project, right? And no one's going to solve this issue by themselves. We're all going to have to work together. I also think that, you know, part of it too is figuring out, like, what are the problems that we're trying to solve for, right? So like for the ECB's perspective, what's the problem that they're trying to solve for? Because that's going to be different, you know, in Europe, it's going to be different in other countries around the world, right? The problems are going to be different. And then therefore the technology or the solutions that we use to solve them are going to be different. So again, not worrying about a one size fits all, hoping to, you know, really just work together and to continue this dialogue to figure out how we can kind of combine the trust and stability that a central bank brings with the innovation that the private sector can bring, and how we do that together. So again, thanks for inviting me. I really appreciate it.
Thank you very much. And Professor Dr. Peter Bofinger, Chair for Monetary Policy and International Economics at the University of Beautiful Würzburg in Germany, and also ex-German Council of Economic Experts, aka Wirtschaftsweise. I hope the connection works.
I enjoyed this discussion, and I think we are doing exactly the right thing here, because the future of European payments and global payments can only be solved in cooperation with central banks, private payments providers, and academics. I think that's what is needed, and so I think we are on a good road now.
Okay, that was the perfect end statement for this discussion. This is exactly what the Digital Euro Association is here for, and this was the embodiment of this. I wish you all a great start into the spring and a great 2022, and this is only the beginning. And yeah, thank you so much for being here.
All right.